at the PE ratio, for example, for example, I show you a company again on the screener. Okay. So look at any company like, Reliance, for example. So Reliance, is trading at a price of 1358, and as we speak, it's up by about 0.92%. You can see on the screen. The pre-market is open, so the, the market opens at 9:15, so it is slightly above, yesterday closing, and the current price is close to about 1358. And the stock P is 24.5. Okay, fine. So if you look at, this company Reliance, what Reliance is doing, what kind of business Reliance is doing, anyone can tell me? So in case if you want, you can just read it through here also, because it is telling you about all the businesses here. Okay, fine. So it is present in basically, oil to chemicals. Okay, fine. So it produces oil to chemicals. Fine. So which is 57% of their revenue. So it refines the crude oil to manufacture, fuels, polymers, and intermediaries. Okay, so that is their main business. Then we have the retail segment. So they are now, have GeoMart and, about 15,200 retail stores. So 23% of the revenue comes from retail. Then they have digital services, Reliance Jio. Now, there's a news which came, about a week back. Can anybody share what was the news regarding Reliance Jio? Anybody? Yeah.
They will have their IPOs
Ah,
in
yeah. So
2016,
they are
I
going to
think.
have their IPO,
2026.
yeah, absolutely. What's your name?
Sir Abhishek.
Huh?
Abhishek Mishra.
Abhishek Mishra. Good. So, Abhishek, and all others, you know that Reliance is going to, have a separate company for their mobile telephony and, their telecom business. So they are going to come up with an IPO, and this company will get demerged from Reliance Industries by the next year and have a separate company. Okay. Like, we have Airtel, Idea, Vodafone. So then, the way they have oil and gas business. Okay. So basically, we see that they are into oil and gas business. Now, there are two kinds of businesses, and 1% of revenue comes from oil and gas, and 53%, 57% oil to chemicals. There are two parts to the business. The first business is that they are going to extract oil, okay, from the sea or Krishna Godavari basin or other places. So what they do is they extract oil. They extract oil, then they, use that oil and refine that oil in their refineries to produce chemicals. Okay, so this is a two-way process. One is, a company is, digging oil, taking oil out of either the earth or the sea, and then that is called the crude oil. And then the crude oil is refined to either petroleum products and other things. Okay, polymers, and they have retail, so they are into lots of businesses. So it is a truly and then they have a media and entertainment business. Okay, so what is their presence in media? Do they have any television channel? Which is called CNBC, 18. Okay, fine. So they have they have a channel through which, they give a business channel. Okay, fine. And they are also into some others like colors and other channels. Okay, so it's truly a conglomerate. Okay, fine. It is present into many businesses, and if you look at their business, then they have a turnover of close to about 9,76,000 crores. Okay, this is net of GST. So otherwise, their turnover is above 10 lakhs. So this is the net income, net sales, which is 9 crore 76 lakhs. Now, this company is currently trading at a stock P of 24.5. Okay. Now, since this is a conglomerate, and if you look at the, peers, look at the peers here, they're the companies which are comparable. So what do you find? Like you have Reliance Industries, IOCL, BPSEL, HPCL, MRPL, CPCL. and Rajasthan Gases. Are they really a peer group company or not? Are they comparable? Reliance Industries can be compared with the Indian Oil Corporation or Bharat Petroleum Corporation or Hindustan Petroleum. Can this be compared?
Uh,
Yeah.
no, sir.
No. Where? Why?
Because Reliance Industry is a combination of many businesses,
Yeah.
and these OICL is a like it's in oil industry only.
Yeah,
So we can't
absolutely,
compare
absolutely.
them.
Again, I think this Abhishek.
Yes, sir.
So, Abhishek, you have rightly pointed out that these companies cannot be compared and they are not comparable at all because Reliance Industries is a conglomerate. It is present to five or six businesses. Of course, their major business is the same business of Indian Oil Corporation or Bharat Petroleum. But now we are seeing that Reliance Sale, Reliance Geo, Reliance Retail. So their, their share is going up. Fine. So they can't be compared. Fine. So if you look at the P ratio of the, other companies of the peer group, the comparison is almost like meaningless. If you see, the like IOCL is trading at 12 and BPCL is trading at 7.81. They are trading at a very low, P multiples, whereas Reliance is trading at a very high P multiple. Now, can you tell me why the Reliance is trading at a higher P multiple? I mean, any first kind of a reaction which comes to your mind that why, a company like Reliance is trading at around 25 P multiple, whereas all other companies in a peer group, they're trading at a very low P multiple. What can be the reason? Abhishek or anyone?
Maybe their earnings
Huh?
will be higher.
Huh?
Their Reliance Industry earnings will be higher.
Huh.
So
Now, Abhishek, now you have to just correctly word it. Okay. So what you're saying is, the end result. But what is the main reason is that, the main reason is that their earnings are more because they have presence into six kind of a businesses, which includes retail, which has a great future. All the companies which are in retail, they're trading at or FMCG companies, they trade at a very high P multiple because there is a greater visibility in growth in those companies. So these companies are bound to grow much faster compared to the companies which are just present only in oil businesses. Okay, fine. So now the businesses which grow faster will always command a higher P ratio. So Reliance Industries is almost like 40 to 50% of the business is such that which is going to grow much faster in the coming times. So that's why it is commanding a higher P multiple. Okay, fine. Is that clear to all? And companies like Oil or BPCL and HPCL. Now, if you look at, for example, Reliance Industries, okay. So, what is price to book value of Reliance? Can anybody tell me what is the price to book value of Reliance?
so 2.19.
2.19. Okay. So, all the companies, normally trade above their book value. Now, book value is basically the value of all the assets minus liabilities, the net assets of the company. Okay. Fine. So price to the book value. So how many times the company's share price is above its total assets owned by it. So normally a company would be always higher than the book value because, because it's doing business. So there is a brand value. There's, a kind of, a lot of business what they're doing. So it will push up the price in the market compared to what asset it owns. Okay. Fine. It will always trade at, higher than the book value. So like you price to book value of a Reliance Industries is 2.19. Okay. Now it is low because Reliance has too many assets, okay, because it owns refineries and other things. So it will always have a price book ratio which is lower than the average. So if, for example, I look at, a price to book ratio of, the Indian companies like Nifty, for example, which is of companies of, say, 50 shares of India. Fine. So if you look at the price to book value of Nifty, how much it is? What is the price to book value of the 50 top companies of India?
So 24,653.
Huh?
24,653.
No, no. What is the price to book value? I'm saying.
Oh, 3.29.
So is the price to book value of Nifty more than Reliance or less than Reliance?
It's more than
It
Reliance.
is more than Reliance because Nifty 50 consists of many companies whose book values are far greater. Like for example, if I look at a company like, for example, which is not so much, asset incentive like, the Asian Paints, for example. So what is the price to book value of Asian Paints?
12.6.
12.6. So it is very big, because it doesn't have much of an asset base. Okay, fine. It has plant, machinery, equipment, but Reliance requires a lot of assets, a lot of buildings, a lot of factories, huge investment. Okay, so the price of the Reliance will not be very higher compared to what asset it owns. Whereas, like Asian Paints, or maybe, if we look at, Hindustan Unilever, which has very small assets, okay, so it will have a price to book ratio of 12.16 again. Okay, so the companies which own less assets, so their prices go up because their businesses are doing very well with a very small asset base. So they are asset light companies. Okay. Whereas Reliance is a heavy asset based company. So it will always command a lower price to book ratio. Whereas, companies like Hindustan Unilever or maybe any bank, for example, which is again an asset, this thing light. So I think Afreen wants to join. Okay. Afreen? हाँ 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 चलो आई हैव एडमिटेड टू इट डोंट वरी ओके आई हैव डन इट ओके 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 सो anybody left? I think we have a lot of students now. Nobody is there. Okay, fine. So now coming back to our this thing, what we were learning is that going back to Hindustan Unilever. So where the company's price to book value is 12.6. So all those companies which are asset light, they will be commanding a higher price to book value. They will be always trading at a higher price to book value. Those companies which are, having a high assets, so they will be trading at a lower price to book value. But all the companies need to trade higher than price to book value, at a higher price to book value. So please mark this thing. What I'm saying is all the companies, whether they are Reliance or whether they are Hindustan Unilever, no, you're talking about, say, for example, banks, okay? Bank. So I was putting that ICICI Bank. So ICICI Bank will also have a high price to book value. It is 3.21. Of course, it is higher than Reliance, but comparatively, it is lower compared to Hindustan Unilever and other companies. But all the companies will command a higher price to book value. Okay, because when you do business, your value has to be greater. The price of the share should be greater than or the market cap should be greater than the value of the assets you own. Okay. But now coming back to, for example, Reliance again. So, and going back to the peers. Okay. Now, peers. Okay. Now, if you look at, IOCL, now tell me what is the price to book value of, IOCL?
1.05.
Is it high or is it low?
Sir, it is, I would say, moderate,
No, it is low. It
neither high.
almost the price of the share is equivalent to whatever assets the company owns. Okay, fine. Because when we
Okay.
look at the Nifty, the price to book value was 3.3. Okay, so all the companies in India they trade at least 3.3 times above the assets or the net worth the company has. Okay, whereas some are very high because they are asset light. Some are very low or less because they are asset heavy like Reliance, okay, which is trading at 2.1. Okay. So, but Indian Oil is trading at 1 point. Now look at other peers, okay. So if you look at BPCL, so where it is trading, price to book value.
1.69.
Now let's say, other company, for example, HPCL. What is the price to book value?
1.6.
Okay. So let's come back to the peers again. Let's come back to the, say, company like IOCL. Okay. How much is trading? 1.05. Now, all these companies which are part of the peer group of Reliance, which are oil manufacturing companies or oil marketing companies, So they have been all trading, historically at a lower price to book value. Okay, of course, they own a lot of assets, so they are asset, heavy companies, so they would be always trading at a lower price to book value. But why the companies, trade at a low to book value? The reason is here is basically because they are all, selling oil, petrol through petrol pumps. And if you see, in even if the petrol prices goes up or down, these people, though they have free hand to change the prices at the petrol pump, they hardly do it because they wait for the government signal. If the government says raise the price, they will raise. Okay, in case if the price in the international market goes up, so they don't immediately change because they need to just get a nod of the Ministry of Petroleum. Of course, the government has now deregulated their prices, but still, these companies, their hands are tied up from the back channel. So they are not able to do business the way what they should do normally. If your price of the input has gone up, your final product price has to go up. Okay. Now, because I mean, their prices are linked to the international prices, so they need to increase the prices so that they can earn the same amount of profit what they were earning despite the price of oil has gone up. So, because the crude oil they buy and then convert them into petrol and then they earn the margin. So, if the crude oil prices go up in the international market, so their profitability goes down because they are not able to pass on the price hike in the input cost in form of petrol prices hike to the customers so easily. They do it, but they do it in a very infrequently. They wait for the government order before they can increase the price at the petrol pump. So since they are not doing the business, of any company in India, or any businessman would like to increase its price if it's not making profitable, or if they have to, be in line with the competition. Okay. So these companies have been normally trading at a lower price to book value because, their hands are tied up. They don't do the business, as they should have done as a normal businessman. So that's why, the investors don't find these companies very lucrative. And if you even look at the stock PE ratio, which is 12.3, okay. So they trade at a very low P multiple because their growth is also, hampered because they can't increase the prices of their final product so easily. They have to, take a permission from the government. So they will command a low price P multiple. Now tell me, let's say, for example, BPCL. So what is the price earning multiple of BPCL? Anyone? What is the stock PE of Bharat Petroleum?
It's 7.75.
Now, is it low or is it high? No, when we compare it to Nifty as a whole, Nifty, what is the price earning ratio of the top 50 companies of India? What is the PE ratio of Nifty?
21.6.
So when we compare this Nifty PE ratio with the, the Bharat Petroleum PE ratio,
It's low.
so it's low. So that means,
Yes.
on an average, Indian companies trade at a PE ratio of close to about 21. Whereas, Bharat Petroleum is trading just at 7.75 at a very low PE ratio. So what is the reason? Abhishek, what is the reason? Or Yashika, are you there? इसका क्या reason है? Why this company is trading at a low PE ratio? Because the company is not making enough profits, It is not able to pass on the prices of the petrol so easily to the customers. So if you look at, for example, their profit and loss account and look at the earning per share, it is what? It is about 39, okay, rupees. Fine. With a turnover of about 4 lakh, odd turnover. So 4 lakh 39,000. So if you look at a quarter to quarter basis also, okay, so these companies, they make profits, but their profits are not moving at a very fast pace. Okay, fine. Of course, if you see, the June quarter has been good because the petrol prices were very low and they were having earning enough margin, maybe. Okay, but they were earning, huge profits in about to 2023 and now to 23. But then the prices, they have a lot of, ups and downs in the profit. Fine. So their profits are not like a rising trajectory. Any businessman would see that the prices of their profits would be rising, every year. So they have, lots of ups and downs because they can't, do their businesses very freely as compared to all other business people. Okay. So that's why they command, a low, kind of a P multiple because the investors are not very happy or not very keen to buy these companies because they don't get any kind of a return. Okay, and if you look at the return also of these companies, fine. So if you look at the return, let's see what is the return you're getting. So return on equity or return stock price CAGR. So look at this. So how much this company has given the return BPCL in the last 1 year? Anyone? Or last 3 years and last 5 years and last 10 years? Equity investing is for a longer period of time. So in the last 10 years, if you look at, of course, there will be lots of ups and downs, during the 1 year, 3 year, and 5 year period. But 10 years return, how much it is given?
23%.
No, no, I'm saying this is return on equity. How much it is earning is different. But how much, despite, having a good return on equity, but investors are not happy. Despite the company is earning a high return on equity, which is 23%, which is considered to be very good, but the people who are investing, they are not investing in, lots of money, and, it is not picking up the share price. The share price doesn't go up. So stock price CAGR means stock price compounded annual growth has been only 8%. If you owned a stock for 10 years, you have got a 8% return. Now, if you have taken a fixed deposit, how much return you get in fixed deposit? Yashika or anyone who spoke just now? Who?
6 to 7%.
So, when you're putting your money in a fixed deposit, you earn 7% and it is absolutely risk-free. But when you invest in a equity market and you get just 8% return, so with lots of risk, like, in the last 1 year, it has given a minus 12% return. Okay. So anybody who bought last year has suffered a 12% loss. Whereas if you buy a fixed deposit, you will not suffer that kind of a loss at any point of time. Okay. So, so here in the 10-year period, you have got just a very small amount of 8% return. Despite the company fundamentals are good, companies into a business which is, always in demand because people keep buying oil, and the return on equity is good, very decent, 23%. But it has not enthused the investor, and they are not, this thing buying it. Okay, fine, and so that's why it is trading at a low P multiple. Now, coming back to, for example, let's go to say Ultratech again, our company, which we have been, tracking all the time. So Ultratech, stock P is how much? 54.2. Okay. Now we all know that we calculate the PEG ratio. Okay, fine. So I'll just take you to the, file which people have been working. So आप लोगों ने ये काम करा है अभी. You have completed your own files. Okay, this you have seen. Are you seeing this on the screen, Yashika? Shruti?
Yes, sir.
Okay. Now, we know that we can calculate the P ratio. Okay. So P ratio is here. Okay. Then we look at the growth in earning per share. So since you people have completed, all of you have completed this growth and PEG. Okay.
Yes, sir.
So, today I'm going to talk about little about PEG ratio, a little bit more. There is another ratio which has come into fore very recently, which is, a little better indicator than the PEG, which is called the PEGY ratio. Okay. So I'm going to talk about that PEGY ratio. Okay. So the growth here means what? Anyone? What does it growth means here? 32.19 means what? Is it the average growth in sales or profits or earning per share? ये ग्रोथ क्या है याशिका? ये ग्रोथ टॉप लाइन ग्रोथ है या बॉटम लाइन ग्रोथ है? अभिषेक, दिस इज अ हाँ.
Oh, it's right on me.
No, I'm saying that
I think, sir, it's the annual growth rate.
can you repeat again?
Sir, I think it's the annual growth rate.
Annual growth rate in what? In earning per share or in terms of sales? Bottom line or top line?
In, I believe it's in earning per share.
हाँ, who's saying I believe?
Sir,
तो
Yashika.
याशिका, आपने तो प्रोजेक्ट बना दिया है ना. इफ यू सी हेयर, दिस इज कमिंग फ्रॉम हेयर. Okay, fine. Growth in EPS. Just look at this. It is coming from here, growth in earning per share. Okay. So, and you are picking these numbers. Okay. Fine. Growth in earning per share for Ultra 32.19. So, this is basically nothing but the EPS growth. Okay. Which is the bottom line growth. Okay.
Mm-hmm.
So, up to our project, you have to make a presentation next week and you should be knowing that what does the growth means. Okay. So, growth is,
Sir, it's EPS
huh?
now. Sir, I said the same thing, the earning per share.
Yeah, you said the same thing, but you said, I think. You're not maybe that your language was not very supportive with what you're saying. So what maybe that you
Mm-hmm.
might have used I think, but that would have normally meant that I know it is growth in earning per share. Okay, fine. So you have to be very clear in choosing your words so that I can get a right signal that you don't think, but you say that it is a earning per share growth. Because you have done your project. Okay, fine. So that's okay. I mean, that may be I mean lack of words. So you said I think. So growth means growth in earning per share. Okay. Now, when you divide the P ratio with growth, you get PEG ratio. Now, how do we interpret the PEG ratio? If it is more than 1, what does it mean? Is it the stock overvalued or undervalued? How you describe a PEG ratio of 1.6 of Ultratech? Is it expensive or is it cheaper? याशिका ये सस्ता है स्टॉक अल्ट्राटेक या महंगा है?
Sir, I think that key stock, if it is more than one, it is
वेरी
overvalued.
गुड, वेरी गुड, वेरी गुड. ठीक है, कोई बात नहीं.
Matlab, the market is a bit more optimistic about this stock
They are
and it's
optimistic,
trading
definitely.
higher
What
than
you are
its
saying is
growth
right.
rate.
Yeah, please keep saying. Yeah, okay, I'll listen. That what you are saying is absolutely right. आप सही बोल रहे हो. बोलो याशिका.
Sir, that the investor that who is paying for the same stock now, they are paying more than the growth is being justified over here.
So that means this stock is trading at a premium to its growth. So, if you look at the strict definition of the PEG ratio, if it is, equivalent to 1, then we say the stock price is rightly priced. If it is below 1, then we say it is at a discount to its the P ratio. The share is trading at a discount to its, growth. When it is trading above 1, when we say it's trading at a premium to its growth. So this company's stock is trading premium to its growth. But then if you look at the median PEG ratio, it is 1.6. Okay. So that means the stock is higher, but compared to the industry, it is still trading lower or almost at par with the the industry. So neither it is very expensive nor it's very costly when we just compare the median PEG ratio. Okay, so that is one way of looking. Okay, but the right way would be that it is costlier stock. Stock is costlier because it's trading at 1.6 PEG ratio. Anything above 1 is costly. But still, when we go to the and see ultra cement recommendation, we find that it says that you should go and ahead and buy it. Okay, fine. So almost like so many analysts are still feeling that despite it is trading at a very high value, they say that we should buy it. Okay, fine. So that is a different matter. Okay, but it all remains that it is, many of the analysts, if you look at this, so there are about, 7 analysts, which is, or maybe three analysts saying strong sell and one saying sell. So there are people who are saying that it's costlier. Okay, it may depend upon who is saying, some 4 people are saying, no, it's very costly. But rest of them, like 4 saying hold. So that means that the 4 people who are saying hold, they don't believe the stock will go up. But if you wait for some time, you may get some kind of a return. Okay. But 35 people are very bullish that no, despite it is costlier, the PEG ratio is around 1.6, but this stock is going to give you a very good return. Okay. So it is basically, despite trading at a high PEG ratio, the stock seems to be still a favorite for the investors, or at least for the people who are advising, the stock analysts are saying it is still worth buying. Now, so there is, because again in PEG, we always feel, whether it is despite very high, of this ratio, can there be some in change to this ratio or some modification to this ratio so that it takes you little more towards, a better understanding the price of Ultratech. So that's why, what I did was I went to, the AI, the chat GPT, and, asked him a ratio. Okay. So the ratio is, let me explain the PEGY ratio. So the new ratio, which I'm going to explain, is called the PEGY ratio. Okay. PEGY. So, Yashika, can you read what is written?
The PEGY ratio is a stock valuation metric that builds upon the PEG ratio, price by earnings to growth. It adds in the effect of dividend yield to give a more complete picture. The formula is PEGY ratio is equals to price to equity ratio divided by earning growth rate plus dividend yield.
Okay, now just hold on. Now, he's saying that take in the numerator, you take the P ratio, as we take in the P ratio, PEG ratio, okay? But add, instead of just taking the growth, earning growth, you need to add dividend yield to it. How much the dividend the company is paying. So you should add that, okay? And then recalculate the PEGY ratio. And it is called PEGY ratio, okay? Fine. So now, first of all, before we understand, this construct that why we are adding this dividend yield. So let's look at, a company like Reliance, for example, and look at various companies. Can you find where is the dividend yield? How much is dividend yield of Reliance Industries? Uh, just see here. What is the dividend yield? Yashika?
0.41%.
0.41. Okay. So if you have invested in Reliance today, and whatever Reliance is giving dividend, what is the current price of Reliance? 1358. Okay. So company is declaring dividend. So if you take that dividend, the company has announced and divide by the current price, you get a dividend yield. Suppose, today the company is declaring, company will be declaring 500% dividend on the face value. It is on the face value of 10 rupees. तो इसका मतलब कंपनी ने 40% डिविडेंड डिक्लेयर करा है. If you look at 41% company has declared dividend in their meeting. Because on 10 rupees, the dividend, I'm sorry. So it is giving 40.41% dividend. On the face value, it may be much higher, maybe 30, 40, 50, 60, 100%. We don't know. We have to check it with the company's data. But when we take that dividend and divide it by the current price, okay, then we find that, if you have bought the share at 1358 and not at 10 rupees, then your dividend will be much lower. The return on dividend. So, if you just go and check on the Google dividend yield formula, okay, fine. Now, can you read this, Yashika?
Dividend yield is equal to dividend per share divided by market per share, where dividend per share is the company's total annual dividend payment divided by total number of shares outstanding. Market value per share is the current share price of the company.
Okay. So that means you're taking the current price. Okay. So we are calculating dividend per share. That means the total dividend divided by the total number of shares. So we'll get dividend per share. And you divide that with the market value per share, you will get the dividend yield. Okay. Fine. So it will be far less compared to, the actual dividend per share on the basis of face value. Because the face value was just, what? The face value was just $10. Okay. The face value is 10. Okay. So, but you will going to calculate how much I am earning on the current price. As if I put my money today and I'm getting the dividend, I'm taking the dividend which the company has announced in the annual meeting and I'm dividing by current price. Okay. So it will be far less compared to dividend declared by the company on its face value. Have you got it, Yashika? Other people? समझ में आया आपको?
Yes, sir.
So dividend yield will be
Yes.
far less. Okay, let's look at another company. Okay, so say Ultratech, for example. So what is the dividend yield of Ultratech?
So 0.6.
0.6. Okay. Now let's look at, like Hindustan Unilever, okay? Liver. What is the dividend yield?
1.62.
Okay. Now you will find the dividend yield will be, most of the companies it will be below 1%, and some of the companies it will be little slightly above 1%. Okay. But it won't be like 15%, 25%, 30%, because the companies are declaring 30% dividend. But when you compare it with the current price, the return falls because the current price is much higher than the face value of the company. Okay. So, uh, like companies like Hindustan Unilever, they are able to declare much higher dividend because, they don't keep the profits, plow back the profits into the business because they don't require the money. Whereas the companies like Reliance, they are, for example, companies like Reliance will have a very low dividend yield because, they are giving less dividend compared to, because they need all that money and for growing their businesses. So their dividend yield will be much lower, okay, like compared to the Hindustan Unilever, because they declare almost 30 to 40% of their profits back to the shareholders, whereas Reliance may be just declaring their 10% of profits to the shareholders. So their dividend yield will be also less by that count. Okay. Now, if the company don't pay dividend, suppose, of course, Reliance doesn't pay dividend at all. So what they will be doing with the profits they have got? अगर कंपनी ने रिलायंस ने वो डिविडेंड नहीं दिया आपको, कंपनी का डिविडेंड यील्ड से जीरो है, फॉर एग्जांपल, सो वेयर द प्रॉफिट विल गो, द कंपनी विच इज नॉट डिक्लेयर्ड, कहां जाएगा वो प्रॉफिट?
So that will be a part of reserve and surplus.
That will go part as the reserve and surpluses, and that will be used for growing the company. So
Yes.
that will grow the EPS much higher. उससे dividend, उससे growth of EPS will go up in future. If the company, like suppose I am a company, I'm earning 100 rupees, okay, I'm not paying any dividend. I'm redeploying that 100 rupees into my business, so I can grow my business faster. I can grow my bottom line faster. So if you're, not declaring dividend, it will add to your growth. But if you are, paying dividend, it will bring down your growth lower. So that's why what we do is in the PEGY ratio, we add the dividend yield because this will complete the story. Because if you are paying zero dividend, the growth rate will go up. If it is zero here, this will go up. If this is more, then this is more and more, this will fall. And this is zero, this will be higher. So this completes that all entire profit of the company, which company is earning, where it is going. Is it going for growing this thing, or the dividend yield is also basically a return which the investor is getting? Okay. So since he's getting the return, so it needs to be added to find out the real valuation of the company. Okay. So just read this, Yashika.
So PE ratio, price to earning, tells you how expensive a stock is compared to its earning growth rate, expected annual percentage increase in the company's earning, dividend yield, annual dividends per share divided by share price, and by including dividend yield, PEGY adjusts for the fact that some companies return to cash to shareholders directly, not just through growth.
Okay. Now, what happens is that we take only the growth, okay, while calculating the PEG ratio, but we include dividend also because the shareholders are getting, dividend also, isn't it? So the real growth for the shareholder is just not the growth in EPS, the growth he is getting by way of getting some dividend also. Okay. So again, the rule is same. How to interpret? Just read this.
PEGY more than one, that means stock may be undervalued, cheap relative to growth plus dividends. PEGY is equals to 1, that means it is fairly valued, and if it is more than 1, stock may be overvalued, price too high relative to growth plus
Okay, the
dividends.
same kind of interpretation that if it is less than one, we say stock is undervalued. If it is one, it is fairly valued. If it is greater than one, we say it is overvalued. Now, look at this example. Suppose the stock has a PE ratio of 20%, expected growth is 10%, dividend yield is 2%, then the PEGY ratio will be what? 20 divided by 12 instead of just 20 divided by 10. So earlier we were getting 2, now we are getting with PEGY ratio will be 1.67. Okay. So it is expensive, but not as expensive as it was just because looking at the plain PEG ratio. PEG ratio would have given a ratio of 2. PEGY ratio, the ratio has fallen. So that means the PEGY ratio further takes care, of, understanding whether share is expensive or not. Okay. Now, let's say, what I did was I just tried to find out, just we'll have a small thing, and then we have uh, 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 a break. Okay, fine. Okay. Now, the last one before the break. So, I just asked, the AI or the chat GPT to tell me, all the companies in India, like, all the nifty companies. What is the PEGY ratio of all the nifty companies? So, but it said that it is not possible to give this information because, all the information is not so easily available. So he said there are about, few companies where he can, calculate the PEGY ratio. For example, Reliance, TCS, Infosys, SDFC Bank, ITC, Hindustan Unilever. Okay. So immediately after this, I'll have attendance. Okay, fine. So then, so he said, okay, I'll just give you the detail. Now look at Reliance. Okay. Look at Reliance, Yashika or Abhishek. Tell me what is the PEGY ratio of Reliance?
Sir, 2.36.
2.36. So how it has been calculated? What is the P ratio? P ratio is 24.6. Okay. Dividend yield is how much? 0.4. We have seen that. Okay. Because we have seen Reliance, dividend yield is what? 0.4%. Okay. So he has included that also here. Okay. Let me go back to this. Okay. Now, what is the growth of Reliance? How much Reliance is going to grow in the next 5 years? Abhishek?
So, so 10%.
So if it is 10%,
approx.
then the PEGY ratio will be 24.6 divided by 10, which is the growth rate, plus 0.4%, which is the dividend yield. So you get a PEGY ratio of 2.36. Now tell me, anybody, what is the flaw in this calculation of this ratio? The AI has calculated the ratio, but according to me, this is not a proper way of calculating the PEGY ratio. Can you tell me what is the problem here? Just think about anyone. I just give you 2 minutes, okay? Afreen, are you there? So this ratio has certain flaw. So I would like to know about this. So Parth Bansal has joined, okay? So tell me, what is the flaw? What is the flaw here? Abhishek, are you there?
Yes,
So
sir.
I'm just showing you again this ratio. Have a look. Okay, take a photograph of this, take a photograph on your mobile. I'm just keeping it open, okay? So it is giving Reliance, TCS, Infosys, and SDFC. Just take a photograph, okay? Then I'm going to ask these some questions from you before you head for a break, okay? So if you have taken, then I'm just going to head for this thing. So Afreen, have you noticed any flaw in Reliance PEGY ratio calculation? Akshat, Ansh duplicate, Ansh original, both of you are there? Say yes.
Yes,
So,
sir.
who
Yes,
is
sir.
the
Original is here.
original, Gagneja or other one?
Gagneja.
I'm
अच्छा
just
ठीक है
करना है.
दोनों ओरिजिनल ही हैं भव्य, आर यू देयर? Harshit, Karthik, Manan, Parth. Parth, have
Hello.
you joined? Bhavya, are you? Bhavya is there.
Sir
Yes,
Bhavya
sir.
Jain, Bhavya
Huh?
Chug. Bhavya Jain or sir Bhavya
Bhavya
Chug?
Chug. Bhavya Jain का है? Bhavya
Yeah,
Chug बोला था
present
मैंने.
sir. Present sir.
तो ठीक है, तुम्हारी कास्ट तो कभी चेंज ही नहीं होगी ना जिंदगी में. तो why you so worried?
नहीं सर हमारी क्लास में गर्ल
अच्छा,
भी है
भव्या
सर
गर्ल भी
भव्य
है.
जैन.
ओके ओके. I can't see. Maybe she is not in our this thing. Yashika, Vansh,
Yes sir.
Vaishali.
Sir, they
हाँ, तो
Yes,
याश.
sir.
sir,
Yes, sir.
हाँ, so
Present.
tell me now. Look at this ratio. Okay, fine. I want to pinpoint a area of concern here. How this ratio is?
sir,
Huh?
they have used the sales growth instead of the
Absolutely,
earnings
absolutely,
growth.
Yashika. Claps for Yashika. Wonderful. They have used what?
Sales growth.
Very good,
Very
Yashika.
good, wonderful. What they
Thank
should
you.
have done actually instead of sales.
Earnings growth लेनी
Absolutely.
चाहिए थी
So that
उनको.
is, if you understand, you can find out the mistake of the AI. Okay, the AI is not going to give you a right, always. So it is going to make a falter into certain things because though it was not able to get a 5-year EPS growth, so what it got was a 5-year top line growth. So he has included a top line growth instead of the bottom line growth. Okay. But anyway, I mean, it was just a pointing out, that what is a mistake. We should know about, that it should be the growth in earning per share and not growth in sales. Fine. So now tell me, Yashika, that's a very good job. You're doing so good. I'm happy. And others also might have been knowing it. I don't know that. I mean, you might have guessed it right, but you were not able to come out. But anyway, so now according to this chart, so we have Reliance, TCS, Infosys, and HDFC and ITC. Now tell me which company is the best out of this? कौन सी कंपनी सबसे अच्छी है? Which company?
Sir, I think it's the HDFC Bank.
HDFC Bank is good. Why?
Sir, because the PEG ratio is less than 1, that means the growth, it is not overvalued and
So
the
this is PEGY
price
ratio, not
does
the
not
PEG ratio,
surpass
but
the
this is the
book.
PEGY ratio. The PEGY ratio is
Sir,
below
it is
1, which means that the stock is rightly priced. It's not overvalued. And what is the factor which is contributing to this, ratio? कौन सा ऐसा फैक्टर है जो जो बता रहा है कि ये कंपनी जो है अंडरवैल्यूड नहीं है? So which is the factor, which is leading towards a lower PEGY ratio? It is the growth, okay? 21% growth compared to all other companies here. Like Reliance is growing at 10%, TCS is growing at 9%, Infosys is growing at 8%, HDFC Bank is growing at almost double the rate than all the companies which are mentioned here. So the HDFC Bank is the best, candidate for putting the money as per this chart. Okay, fine. So now, we come to a break. So we know that, a lot of students are there. And let me see how many students are there. There are 20 students. Okay, fine. And how many students? Shashank, are you there?
Yes, sir.
So
I'm
how
there.
many students we have in the class?